Ever feel like your home country is just taking more than its fair share? High taxes, rising costs, fees for literally everything. It can feel like no matter how hard you work, the system is rigged to bleed you dry. If you're a freelancer, a remote worker, or a small business owner, there are ways to legally break free. But you have to understand the rules, because each country plays its own game. Today, we're going to talk about some of the big players: the UK, Australia, Canada, New Zealand, and the US. And I'm going to show you how people actually escape high taxes without breaking the law. Let's start with the UK, because it's one of the trickiest places to leave historically. The UK used to have a solid non-dom scheme, where if you weren't domiciled there, basically meaning your permanent home was somewhere else, you could avoid paying high tax on foreign income if you claimed the remittance basis. That's disappearing in 2025, which is a huge change. So how do you escape UK taxes now? First, you need to spend fewer than 183 days in the UK in a tax year. That sounds simple, but the UK has all these extra automatic overseas tests that look at your work, family, and where your main home is. If you leave for fewer than 5 years, HMRC can still tax you on certain capital gains when you return, so it's not enough to just leave temporarily. The key is making your new overseas life real. That means an actual home, real connections, a business or work there, not just a PO box. And you have to keep clear records: flights, visa stamps, bank statements, everything that proves you're genuinely living elsewhere. Timing is critical. If you leave too early or too late, you could still be liable for UK tax. Now let's move to Australia. Leaving Australia isn't as simple as booking a flight either, and it's increasingly cracking down on departing residents. Australia looks at whether you have a permanent home there and your other connections. Just being overseas for a year won't make you a non-resident for tax purposes. When you leave, you might face an exit capital gains tax on most assets. The government essentially treats you as if you sold your property and investments the day you stop being a resident. You can defer the actual payment until you sell, but it's usually at a higher effective cost. The trick in Australia is twofold. You need to make your overseas home legitimate, and you need to cut significant ties back home. That includes selling or renting out property, closing local accounts if possible, and reducing day-to-day Australian connections. Once you're truly non-resident, Australia will only tax income sourced in Australia, things like rental income from property back home or Australian dividends. Everything else is fair game to keep for yourself, legally. But be careful. One of the tests for residency in Australia requires you to demonstrate you have an actual home abroad. So if you're just floating around with no actual set base, the ATO may still view you as fair game. Canada has its own style of exit rules. They have what's called a departure tax. Canada cares about your residential ties. That means home, spouse or dependents, personal property, social connections, and financial connections like bank accounts. To leave effectively, you need to sever those ties as much as you can. Canada treats certain assets as if you sold them on the day you leave, taxing any gains immediately. After that, they only tax Canadian source income. Timing here matters a lot. Selling or gifting certain assets before leaving can save thousands, so you need to plan your departure year carefully so you don't trigger unnecessary taxes. The positives? Canada is usually less sticky than Australia in terms of proving a home abroad. Generally, if you make a clean exit and break ties once, you'll be safe. Now let's talk about New Zealand. Compared to the UK, Australia and Canada, New Zealand is a bit simpler, but you still need to plan carefully. To become a non-resident for tax purposes, you need to spend fewer than 183 days in any 12-month period, and importantly, not maintain a permanent home there. That's the big one. If you leave a house, apartment, or even a fully furnished place available to you, the tax authority can still consider you a resident. Once you're genuinely non-resident, New Zealand only taxes income sourced inside the country. So foreign wages, overseas investments, and most assets held abroad are safe. You do need to watch certain investments though. Some revenue account investments can trigger a limited exit tax, so it's worth checking your portfolio before leaving. Finally, the US, and this one is brutal. Unlike the other countries, US citizens are taxed on worldwide income no matter where they live. It's kind of unfair, right? Though, there's a partial relief called the Foreign Earned Income Exclusion, which protects a bit over $100,000 of your income. But for most people serious about escaping high taxes, The only real solution is renouncing citizenship. And that triggers an exit tax if you meet certain thresholds, meaning the IRS treats your worldwide assets as if you sold them on the day you give up your passport. It's not a step to take lightly. This is a complete severance from the US tax system, not just a change in residency. And with that often comes a complete severance from your life in the US, so you need to be certain that this is the right decision before acting, because it can't be undone. So, once you're out, where do you go? This is just as important as leaving. Zero income tax countries like the UAE, Qatar, or Caribbean havens are obvious choices. There are also low tax or preferential regimes. Portugal, for example, has residency programs, though not as good as they used to be. Malaysia has a remittance-based system, and Thailand offers long-stay visas. And digital nomad visas are now widespread, perfect for freelancers and small business owners. The key is that your new base has to be real. Authorities will look at where your home is, where your family is, where your bank accounts are, and where you work. A fake address isn't enough. Your overseas life has to be genuine. And don't think escaping taxes is just about moving. You need to notify authorities properly, file final returns, report foreign accounts in some circumstances, and keep meticulous records. Timing of asset sales, property, and investments is critical. Doing it wrong can cost you thousands. Non-tax consequences matter too. Healthcare, pensions, and social benefits often stop when you leave, so factor those into your plan. Finally, stay ahead of the game. Tax laws change constantly. The UK non-dom rules are gone. Portugal's preferential program is phasing out, and OECD and EU rules are harmonizing cross-border work and digital taxes. If you want to stay compliant and actually save money, you have to stay flexible, informed, and plan your moves carefully. Bottom line, escaping high taxes isn't about hiding or breaking the law. It's strategy. Cut ties, plan asset moves, pick the right country, and make your new life real. For freelancers, remote workers, and small entrepreneurs, this can mean the difference between watching your money vanish or keeping control of it. Play it smart, plan ahead, and make the system work for you, not the other way round.